Welcome to the On the Tape podcast. I am Danny Moses, fortunate to have Ivy Zelman on, founder and executive vice president at Zelman Associates. I met Ivy while she was an analyst at Credit Suisse, covering housing, and had one of the more famous quotes and questions in Wall Street history, which she asked Bob Dole on the Q4 2006 earnings call, "Which Kool-Aid are you drinking?" in response to Bob's comments about the things in the housing industry we're looking up. We'll get into that. We also have The Big Short in common, as Ivy is certainly mentioned by Michael Lewis as it relates to housing, as all roads lead to Ivy. And not to be outdone by Michael Lewis, Ivy herself is a writer and wrote a memoir called Gimme Shelter in 2021, which we can get into that as well. Before we get your thoughts on the housing sector, I think it's important that listeners hear about the path you took to get to where you are now over the last 30 plus years on Wall Street.
Well, thanks for making me feel really old saying that, but you're old too.
Yes, our gray hairs are proof of the GFC for sure. But
Well, I'll keep it short. I mean, my 30-year plus career has been predominantly being the housing analyst I am today, but I really went about the coverage of our space by relying not on public companies to tell me what's happening in the market, and really developed a very strong network in an easily very highly fragmented market, which made it easy to talk to private companies about what the trends were. And it enabled me to stay the course when, I felt that the market was not doing well and was really fraught with risk. It was because of that private network that I really was able to stay the course. And I think that's why back in our times together, when Big Short, pre-Big Short, but we were all negative, and it was that network that really enabled me to know what was happening in the market. And I thought it was an easy call back then. And I think you did too. We all did, when we were kind of pounding the table. But I don't know if that's what you wanted to hear, but that's kind of what I've done and continue to do to differentiate our work.
well, I think you're being modest, and I think you're glossing over the path that you took to get here, which is over those years, being a woman on Wall Street. We knew what the setup was back in the 90s and how you persevered through that. And it made you who you are today in terms of dealing with these obnoxious Wall Streeters, dealing with them. But talk to that a little bit, because you had some calls back in the 90s that were, or maybe the 2000s also, as it relates to something like asbestos warning in building products that went on that kind of helped set you apart. And you just mentioned before that you rely on your surveys. We're going to get into those, that you do, rather than listening to CEOs, which Porter, Vinny, and Steve and myself will always say will lie to you when they give the opportunity. So just give me a little more color here on dealing with that, starting your career on Wall Street as a woman, because it was not easy.
No, it wasn't. But I think looking back, when I started at Salomon Brothers in 1990, I had gone to undergrad for 6 years and put myself through school, working full time. So when I got there, I was one of 3 women out of 70 financial analysts that were hired for a 2-year program. And, I had worked prior to that as a full-time secretary for Arthur Young, now Ernst & Young. And it was like my boss would tell you, hey, can you do this on a Friday? And you bring it in on Monday. And he's like, oh, thank you. At Solomon Brothers, you didn't leave Friday until it was done, whether Friday, became Sunday, and you were basically a slave. And I noticed a difference between how the guys were treated, because some of the guys would walk in, 11 a.m., but they were drunk and they had a big night, and the managing director's like, oh, dude, tell me what happened. And, but there was nothing even comparable that women could get away with. And there was, clearly a distinction in how we were treated, but it just made it more important to perform. And I think that I never really thought of it. I was not as intimidated by being a woman. I grew up in New York. I can handle any guy. It was the Ivy League that really intimidated me. They were all from Princeton, Yale, and Harvard, and I came from a state school. So that was more an issue than being a woman. But I had to speak up. I had to stand up for myself. And I think I always had a big mouth, so I wasn't afraid to ask tough questions. So I went into equity research, and I would start just asking questions to management teams that a lot of people, I guess, didn't feel comfortable asking, or didn't want to make the management teams upset. But I never held back. And I think that was really something that stood out. And in the 90s, I guess my first really big call was asbestos, I think. It's hard to remember. But I went against the grain and went against USG and Owens Corning, and they were companies that, I believed would go bankrupt because of asbestos. And again, stayed the course went up against analysts that were recommending those stocks. So it was hard because you're wrong initially until you're right. And so having that conviction when you know that you're eventually going to be right helps you stay the course when you need to be grounded in your own views. And then you find people like, Vinny and Steve and all of you guys also, like, I'm not crazy. I know what I'm doing is right. So I think that it becomes very difficult to not stay the course when you are emphatic about what the work you've done and you really feel confident. But it's also having others that might be a very, very small minority, but that also support and agree. But I think by yourself as a lone ranger, it'd be harder. But I had a good team and I had industry executives that were helpful in helping me make that call too on asbestos. And I remember hating Warren Buffett because he'd get, I was home on maternity leave, my first daughter, and USG got pounded on asbestos, and all of a sudden I get a call and I'm home and stock's up 20% because Warren Buffett took a position in USG and he had already owned the bonds, but he bought the equity, and he's on CNBC, talking about all the great things about USG. So my sales force completely, lost confidence in my call. And I doubled down and said, you got to short it into this, you got to. And I just remember being pissed, and I'm watching Warren Buffett talk his book. And I'm like, this is total bull that these guys get on and they make the stock go up. And that was like my first experience of recognizing that people in his position can move stocks and in such a way that doesn't matter what risks in the near term. So it was kind of crazy, but it was very vindicating at the end.
Well, you also wrote some other reports, which were way before their time, which is in July 2005. I hadn't met you yet, but I was in the industry and everyone knew who you were. And the people that were trying to short housing at that time period already that were deemed to be early had seen the writing on the wall. And you wrote Investors Gone Wild in July 2005, which was really kind of the thesis, which was to set up to what would happen in the GFC. So when you write a report like that, which probably fell on deaf ears at Credit Suisse to many people because everyone's about immediate gratification. How is it going to help me now? That kind of set the table for what was going to happen, correct?
Yeah, I mean, that was crazy during that time. I mean, I think we had 1,000 people on our conference call. And, there was other parts of the firm besides equities that cared. Obviously, the asset-backed security guys, fixed income. So I had a whole Credit Suisse, really collectively having to pay attention to what we were saying because it affected so many areas. But I'd say that was right at the cusp of when inventory started rising. And for the period from July 2005 to September 2006, the stocks got killed. They were down 40, 50%. But then there was this blip where people thought the market was recovering, and we doubled down and sell them all and put out a note. So, I didn't have a lot of friends. Builders called me jihad. I had, buy side analysts that hated me and tried to get me in trouble. I remember I was just telling a story that this Fidelity analyst, go nameless, complained to the salesperson because I was asking questions that were really unnecessary and took up too much time about the mortgage market. Like, I'd ask the management teams, please tell me your average credit score. Please tell me your loan to value average. And she's like, she's wasting so much time. And like the whole thing was about the mortgage industry, and the bubble. But so, back then it was the beginning of the end, was the Investors Gone Wild. And it was no question. I once had a builder I was on stage in Aspen presenting to the industry. So it wasn't institutional investors there, just myself. I'm not an institutional investor, but my client base wasn't there. And in the audience, unbeknownst to me, is the CEO of WCI. And so I'm on stage and I just published Investors Gone Wild. I remember I was wearing a white suit. I don't look great in white, but it was a good suit. And I'm on stage and I got my slides up, and it was clearly I mentioned the froth and investors and how I go, WCI is a poster child for investors in their condos in, Florida and South Florida. So whatever I said, I definitely called out WCI. So I'm getting off the stage and I swear this guy was like freaking running back. He's coming at me. And I was like, yo, back up, And he's like, you have a hell of a nerve. He's screaming at me. By the way, he's gone. Company went bankrupt. Carl Icahn bought WCI. So we went up against each other too, which was fun.
And then fast forward, obviously, I just mentioned at the opening the Bob Toll comment on the Q4 2006 call, which was obviously in early 2007 when he said, I see an uptick going on, within the industry. And you said, which Kool-Aid are you drinking, to him on a call, followed soon by March 2007 when New Century filed bankruptcy. So it wasn't long between that conference call and New Century, which was, everybody knows, a subprime mortgage company that was out there. And that was truly when things got completely cemented, that this thing was on course to go, correct?
Yeah, it's funny because my son will say to me, who's 22 and he's like a 40-year-old, he'll say like, "Mom, when did you become vindicated? When was the moment? Can you look back on it?" And for me, it was when New Century filed. That was the beginning of the end. But believe it or not, it felt like forever on the Bob Toll conference call. I was so pissed. I remember just being, losing I'm now mature. I try not to, do things like that anymore. But, when I asked that question, what Kool-Aid you're drinking, the stocks went up in my face for 3 months. That was the early mid-October when they reported. So in December of 2006, we put out a report called 10 Reasons to Sell Home Building Stocks, and it took us 5 minutes to write it, my colleague Dennis and I, because we were so pissed and the stocks were in our face. My product manager at Credit Suisse told me that, you were right. It's time to get off the call. You're viewed as a perma bear. You need to pack it in. You're going to get fired if you don't change your course. And I was like, screw you, and just put out that 10 reasons to sell home builders. And then it was fun in March. I mean, I shouldn't say it's fun. People got destroyed as a result of it. But for my career and me personally, it was pretty rewarding when we saw them file, even if it was awful for a lot of people.
Well, that was the time period where literally I think we were talking to you every day, and Steve Eisman would probably call you 5 times a day. Ivy, what's going on, Ivy? But what was amazing is we had all the data and we were watching credit blow out, right? Because we were obviously buying credit default swaps on these mortgage companies themselves and on the mortgages themselves, I should say. And so we saw it happening, yet it wasn't getting reflected yet, to your point. So it gave us more confidence. That gave you more confidence out there. So you're a great example of having someone on here today where listeners and viewers, whether they're invested in the housing sector or building products or not, they probably own a home. So this is the one category where people care because it affects them personally. So whether invest or not. So I think it's great. So the housing industry is always dealing with challenges, but you talk about immigration issues, inflation, tariffs, interest rates. It has it all, right? So give me your current views on the builders themselves. We'll get into the subsectors in general and kind of the sector and what your thoughts are here present day.
Well, we've been neutral on the space, and we have a relative rating system. So we rate our sectors neutral, outperform, underperform, or market perform. So we haven't been recommending the builders, but within the space, we try to then pick the winners versus the losers, and that's our current rating system. But our view is that it's a really challenged market. Not only is affordability stretched on the existing home side, affordability is about 25% stretched relative to historic trend line. On the new home side, it's interesting because it's only about 10% stretched relative to a historic trend line because the builders have been buying mortgage rates down really since 22. And it's interesting because, I said to the CEO of Meritage at my housing summit in Boston in September, I said, when are you guys going to get off the crack? When are you going to pull back on incentives? And his response is, we're not. This is, we're competing with the existing market. They don't offer mortgage rate buy downs. But what's interesting about it is that, the last, month or two, we've seen rates compress 50 bips from the peak after initial backup in rates. But when you call the builder and say, hey, have you seen a response? Because, rates have dropped. Well, no, because we're offering people 4.99. They don't know if, it's been the same rate. So they kind of have now the backlash and the consequence of getting people used to the current, buy down. Margins are under a lot of pressure. I mean, Lennar just reported earnings last week, and typically incentives account for, in a normal period, between 3 to 6% of ASP, which is average selling price, and Lennar was at 13%. And I think that's really the way that they're getting the volume that they need to hit their goals and get to the closing objectives that they had. Other builders have been sort of caught, like KB, who just reported last night, and they are falling short of their volume expectations because they weren't willing to be as aggressive on incentives. But now they're doing base price reductions, and that might start to get more attention from buyers in the market seeking value. But Lennar is also doing some base price reductions. They kind of include if it's a 10,000 base reduction in what is net incentives. So it's a really challenged environment. The bad news for builders is that we have so many headwinds. You mentioned the few, whether it be immigration, tariffs, those things have really not, I should say deportation. They have not become prevalent enough yet to see. However, the builders will push back on suppliers and vendors that try to raise prices to them because housing starts were down 4% in 24, but realistically, they're really challenged. So they're not going to easily take price increases. They'll try to push back. But besides tariffs, deportation risk on labor, they have inflated land that they continue to buy and they don't have pricing power. So margins are under pressure even without that new tariff and deportation risk. The structure of their business is such where they're going to feel that without pricing power, they're going to feel pain on the margin, which will put pressure on bottom line, which will put pressure on ROE. So right now, it's not a place you want to recommend them, and they're not cheap enough to say, you know what, back up the truck, because at some point they will be cheap enough as a group that you have to look past weak fundamentals, but they're certainly not there yet. They're probably got another 25% downside on average.
I will note that the home builders traditionally trade, obviously multiple book value, given whether it's peak or trough, and then also on their earnings potential. But right now, we're kind of in no man's land in terms of KBH. I'll point out that you had an underperform on even when it was trading literally at book value. So we've seen builders trade at, I want to say, 0.2, 0.3 times book value at times when people didn't believe that the assets were worth what they said. So one thing you brought up, which I want to harp on, is mortgage rates. Obviously, whether the builders themselves are buying down rates, and for people out there that don't understand, when you buy a new home, they can offer you a rate that's below market just to get you in. It's just a cost of doing business for them. But we've seen treasury yields drop, but mortgage rates have not dropped to the equivalent anywhere near where treasuries have dropped to. And I think that's a big misnomer in the marketplace, is kind of call it, mortgage spreads, so to speak. So what's keeping that wide relative to treasuries that we've seen in the last, few months?
Well, historically, the spread between the 10 and the 30-year fixed mortgage rate has been about 100, call it 160, 170 basis points. And right now it's running about 240 basis points. It was at one point 300 basis points. And I think the biggest reason for that is that the Fed had been in a runoff, which now they're pulling back on runoff, but not for mortgage-backed securities. They're doing it for treasuries. So there's just less demand by the Fed and there's less demand by banks. So whether it's the capital ratios, they're pulled back on buying MBS. So the two biggest buyers in the market being absent to the extent they were is caused more, risk and less demand. And therefore those that are buying MBS require a bigger return. But you also have the risk as rates are coming down and prepayment speeds accelerating. And that concerns predominantly Ginnie investors. So they want a bigger return if that comes to fruition. And then you can argue that it's also about potential risk of default. So if you were worried that the economy is going to go in a recession, that might be another reason why the spreads remain wider than normal.
Right. So the Federal Reserve, for people out there, obviously this quantitative tightening is now focused more on, to Ivy's point, letting mortgage-backed securities keep running off and potentially reinvesting the mortgage-backed runoffs into treasuries, which I actually mentioned at some point. So you're right, the biggest buyer is no longer there. Staying in Washington with that, with potential privatization of Fannie Mae and Freddie Mac, and also want to touch on the FHA, which we've seen some really interesting things come out. Fannie and Freddie, which I think will always be, quote, guaranteed by the U.S. government, whether they're private or not. Those going private, I would think, also would potentially widen spreads. Am I right on that?
We think that it would result in much higher mortgage rates. It has to. I mean, from the demands that the private investors that they're depending on require good returns. And the question is, and when business is not as good, what happens in that period? Because it's not, in my mind, like permanent capital. So I think there's a lot of risk associated with them coming out of conservatorship. And I think the industry is going to push back hard. So I'm pretty cynical that that's going to happen and do so in any kind of near-term time frame. But the industry is going to push back hard. And I know that Besant and Bill Pulte and the momentum is more that it's going in that direction. But I think they're going to find that it's just not achievable without creating real risk to the market. And if they do it, it's going to mean higher mortgage rates.
Well, no one's talking about that yet. And I wonder if that's going to fall on deaf ears, but you certainly could be a voice for that. And then FHA, which I know really caters to lower income consumers. There's some turmoil there, not just in how these loans are performing, but potentially the future of the FHA and what that could mean for access to housing.
Well, I think that the FHA, which allows only a 3% down payment, you can also have a back-end ratio, which means all of your debt as a percent of your income, not just your mortgage debt, but your car loan, your credit card debt, could be over 50% and be approved. And I think that that's really the way they get first-time buyers in the market. And so there's been this premise that the loose lending creates risk. And certainly we've seen delinquencies, early stage delinquencies have been rising. And we're not at a level where, back where we were in the GFC or anything, but we're definitely seeing trouble brewing with vintages, the most recent vintages going delinquent faster and higher. But in terms of disruption, whether the Trump administration wants to, downsize FHA, I don't know what's going to happen on that front, but it certainly would be very negative for the housing market. Right now, I'd say a third are entry-level buyers. Not all buyers in the market are using FHA that are entry-level, but I'd say it's probably 15% of all housing is FHA. So it's a big chunk of the market.
Right. So we talked earlier about surveys that you do in the market, and one area that you really focus on those surveys is building products. So we just saw a deal announced. AZEK is being bought here by James Hardie. AZEK, I guess, just builds artificial decks. And then a deal that was rumored last fall, which also was just formalized, was Beacon being bought by QXO. I'll note that on AZEK, the takeout price was exactly where you had fair value for the company. So will you see continuous consolidation within building products as they face a lot of the issues we talked about as it relates to costs and inflation potentially?
Well, within the public markets, I wasn't calling for either one of those companies to be acquired. So I think that it's difficult with the cost of capital today and the appetite for consolidation still there. It kind of two opposing views. It's expensive, but if there are potential buyers out there, I wouldn't say no, but I do think that the building product industry does face a lot of turmoil. So there's some that might contemplate it's time to partner or sell, but we certainly weren't looking for those to come to fruition. The Beacon one, they were holding back for a while and they finally capitulated. And I think it ultimately be a good thing for the industry. But more commodity oriented, like roofing is, as a distributor, that's easy. But when you start getting in more decorative and consumer oriented, I think it gets a little harder to see the appetite there. With AZEK, you call it artificial decks. It's funny. Composite decks, which are, popular. I think for thinking about James Hardie is outdoor exterior, harding and siding, an alternative to vinyl that's more durable. They need to grow, and for them, they needed alternative products, in my opinion, which is why they look to AZEK. So, in that situation, making the acquisition can help them their long-term growth, but we'll see. We'll see.
I'm just wondering if that industry consolidating or that subsector consolidating is another headwind for the builders themselves, because the pricing power could come a little bit more if there's some type of consolidation.
I think so, ultimately, but at the same point, builders have a big stick in the market, and they might find that they have enough volume to push back, and some of the larger builders will be fine. The smaller builders or mid-sized builders, the KBs of the world, will not have the same potential ability to push back like a Lennar or Horton could. So I think you'll see some different differentiation on, who can withstand more than others.
One of the tailwinds in the sector is the amount of equity people have in their homes, and they can tap that equity and make improvements, remodeling, whatever it might be. And two stocks that people love to trade and love to watch are Home Depot and Lowe's, which I know you cover within the home centers. Without going into those names specifically, what do you think of the sector, and are you starting to see those tailwinds take place?
We don't like the sector right now because I think home improvement, when you think about the correlation for home improvement, people's immediate response is housing turnover. And housing turnover has been at recession lows, like the 35-year lows at 4 million, roughly. And that's really been an interesting dynamic just to point out, because even though we're at recessionary low volumes in existing home sales, we actually have home prices still rising, which has never happened. where you have the volumes at such depressed levels with pricing still accelerating. And a lot of that is the backlash that the Fed has now experienced from the interest rates coming down as much as they did during COVID with their policy to, pretty much policy of zero interest rates. Now people are locked in well below where prevailing rates are. So when you have that phenomena, people are stuck because they don't want to sell it and give up this low rate. And if you correlate home improvement spend to home price, change in home price, it's 93% correlated, and home prices changing are decelerating. So people, as they worry, if you're sitting in my second home neighborhood of Naples, which I get every day, an email with another price reduction for one of my neighbors, it's wonderful. Not. That community is sort of the domino effect as an example of what happens when people get nervous that home prices are going to come under pressure. You start to see accelerated selling, and you certainly don't see people putting their hand in their wallet to go do a big home improvement project because they're worried about what's going to happen to the value of their home, even if they're up substantially. So I think you have a combination of home improvement is going to continue to be challenged with all the uncertainties and the fact that home prices are starting to decelerate. In some markets, they're already going negative, like Naples.
So another area of people that can't afford homes are apartments and single-family home rentals, and that's become an important part of the sector in general, right? As housing affordability has pushed people towards them. What's happening there? Are we going to see rents begin to moderate, or is it just market by market in terms of the city that you live in?
No, rents have already moderated. In fact, new move-in rents have been under pressure, flat to up slightly. Renewals have remained sort of in that 3% range, but below historic pre-COVID levels. So the industry's already been feeling, and it should feel the pressure from affordability being stretched in that part of the ecosystem too. Because rents went nuts, as you know, during COVID, not just for apartments, but for single-family rental. So I think that we're going to likely see that remain rents into SFR below trend line. And the affordability is not as stretched as for sale. So I think that market likely outperforms as long as the overall mortgage rate environment does stay elevated, but I don't see that pricing power is coming back very quickly. Apartments rents have been under pressure for 2 years, but it's been a function of too much supply that was started, call it back during COVID and into 22. That's predominantly Sunbelt, and that's where there's a lot of lease-up competition. So rents there are under a lot of pressure, whereas in, let's say, Cleveland or in the Northeast where there's not a lot of supply, I say Cleveland, that's where I live, where you go out west and in California where there's not as much supply, you're seeing that rents are reaccelerating.
So housing went through a secular change during COVID. Obviously, people working from home, moving south, to your point, moving to the Sun Belts. And you brought up a point for that you're now seeing in local markets where home builders are active. That's where you're getting the affordability changes that people are actually able to buy. So people now are actually searching out cities of where they want to work, potentially certain companies in areas based upon that, which is really interesting. Like I mentioned before, housing is the driver of kind of everything in this country. So what are you seeing there on kind of the local level, and how do you separate kind of the secular nature from the cyclical aspects of housing?
Well, I think, if I understand your question correctly, migration into the Sun Belt, doubled from what it historically had been. We always have people from New York moving to Florida or New Jersey to Florida or, going east to west or east to southwest. What I'd say is that has now fallen in some of the biggest beneficiary or markets that were the biggest beneficiaries that have fallen below where it was pre-COVID. So migration patterns have shifted not only back to normal patterns, but even fallen in some markets below normal. So the dynamics there, I would just say, have a lot to do with whether people being called back to work full time in the office or 3 days a week, or people are just taking chips off the table. My house doubled over the last 2-3 years. I think home prices are under pressure. I'm going to take some chips off the table, maybe go further inland, or maybe I don't need that second home anymore. Or maybe I don't need that investment property. And people are talking at barbecues or cocktail parties, and they're worried, and they're seeing the market much more competitive and more challenging to sell. And then they'll talk to their spouse and they'll say, maybe we should get out, maybe before it's too late. So that dynamic is happening in a lot of the bubble-ish type markets, Austin, Florida markets, probably most of Texas markets. Those are the most challenged. Phoenix, Vegas, where we had the biggest upside to home price. Those are the markets that will struggle the most. Is that cyclical? I don't know that it's cyclical. To me, I guess It's not secular because it's just the way the market works. Markets go up and down, and the consumer knows they had a huge windfall in those markets. So it's probably pretty prudent for them to start taking, money off the table and, contemplating where else they want to live. I would envision over time that we'll see a shift into more affordable markets if the market remains as stuck as it is. And some of the markets that I think will be beneficiaries, like take Columbus, Ohio, where there's a lot of influx of migration today because we have a huge shrimp plant being built there, $20 billion. And so where can you live in the country today where it's still affordable? Midwest is definitely a region that's one of the beneficiaries that I think that will come to fruition.
So most people that write books about their careers and lives, that's the end of their career. They do it at the end. You wrote a book, Gimme Shelter, in 2021, yet you continue to write research, continue to have success hosting conferences, as you mentioned. Talk about the book, what prompted you to kind of write it, and then let's talk about how people can access your research today.
It was actually our head of marketing, who was new to Zelman, heard my story, putting myself through school and being a woman. And she's like, oh, it'd be really good. You should write a book. I was like, no way. And she just kind of said it'd be good for the company. But it was really something that she put in my head. And I would just sit by my fireplace and just start writing. And it took me about 2 years. But as I was writing, and maybe I was going through a midlife crisis, whatever you want to call it, but I think that the thought was, I want to pay it forward. You can get to Wall Street. It's just a matter of perseverance and determination. And that I wanted to share my story with people that hopefully would benefit from it. And I've been working a lot with high school kids in my community. That I did high school back when my kids were in high school, talking about jobs on Wall Street or my career and hopefully influence them. And then I started talking to college kids and really liked it. I am like a teacher. We teach our clients about the sector. So I think for now, it was really my way of being less of a capitalist, doing something good. It was supposed to be just a sort of a capitalist idea to start and help the business, but then it turned into something else. And I've been having fun. I actually started teaching a class at Case Western, and it was last fall, just to teach students how to value equities using more of a interactive approach, bringing in management teams and letting them see the real world. So it's been a lot of fun. I felt like after I wrote that, I was, oh my God, what did I do? Because I'm so vulnerable. But it was a good catalyst for a lot of change in life. My company got acquired, had a big liquidity event, got rid of my ex-husband, which was great. And that book was sort of all of it summarized to change. It was good.
So the current chapter of your life right now, you're still writing research. Your firm was acquired by Walker Dunlop. How can people find it? And I know your research, like as I mentioned before, goes to the industry, just as important for them as it does to investors. So how do they find you?
You can reach out. You go to ZelmanAssociates.com. Go reach out to Kim at ZelmanAssociates.com. Just email us or go to the website and shoot us a message. But I think that there's a lot of value in our ecosystem because we don't just cover one sleeve of the housing market. You have to really understand what's happening in every aspect of housing, from mortgage to rental to for sale, new construction. It's happening in building products, as you pointed out. And I think that's collectively our advantage. And we utilize proprietary research through survey networks and thematic approach that I don't think is really done elsewhere. So thanks for the opportunity.
Yeah, there's no question. You present the best mosaic, I think, of the industry. And like, as I mentioned before, it's important as an investor, but also as a consumer to follow. So Ivy, thank you so much for coming on. And I know this is going to be a sector that's going to be talked about forever, but certainly with Fannie and Freddie. And I'd love to have you come back on to talk about that soon.
Great. Thanks, Danny. A lot of fun.